Hello everyone, welcome back to the Value Investor Show. Today I want to talk through the top 5 undervalued stocks in my opinion to buy right now. The agenda for today is simple. I'll walk you through the 5 stocks that I believe are still undervalued today. For each stock, we'll go through the business overview, their financials, my intrinsic value calculations, and finally my next steps, whether I'm buying, selling, or holding. But as always, I want to thank you so much for the support. I spent a huge amount of time and effort putting these videos together, but surprisingly, only 30% of you are actually subscribed. So if just 1 in 5 of the remaining 70% of you subscribed, it would help me massively hit my 3K sub goal. So please subscribe if you haven't already. To give you a bit of a market context, the S&P 500 is at all-time highs, and finding undervalued opportunity gets more and more challenging by the day. Back in April, back in May, I think we had the most opportunity in the market, and that's when I loaded very heavily on several stocks. But since June, July, I have struggled to find opportunities that trade below intrinsic value with a big enough margin of safety for me to enter, for me to invest. That said, I do think we could see a correction sometime soon, and I only say that because the data suggests it. If you haven't seen my latest video on why there could be a correction or crash in the next couple of months, I would highly recommend you check it out. The Fear and Greed Index recently showed a neutral rating for the first time in a while. We had the greed for the longest time, and now we are seeing a shift. Now let's see how this will shift in the next few months, whether it will shift to fear or swing back to extreme greed. There are 7 stocks driving the S&P 500 to all-time high, the Magnificent 7 or Mag 7, and these stocks make up the biggest chunk of the index and essentially drive most of the movement itself. For example, Nvidia alone makes up about 8% of the S&P 500, so you can imagine how heavily dependent the index is on those 7 companies. Apart from Apple and Amazon, the rest of the Mag 7 have grown strong double digits the past 5 years, especially when you consider that the historical average yearly return of the S&P 500 has been around 10 to 15%. The fact that these 7 companies have been compounding 20% annually is astonishing, and a major reason why the S&P 500 has doubled over the last 5 years. Which brings me to the first stock on my list, which is none other than Amazon, the worst performer of the Mag 7 over the last 5 years, having only risen 40% the last 5 years at a CAGR growth of less than 10%. In the next 2 years, Amazon will reach 860 billion in revenue and 100 billion in net profit, and I believe will be the first US company to reach 1 trillion in revenue. That means at today's valuation, the forward plus 2 years PE ratio would be just 22. So we're talking about a company with a massive growth expectation trading at a multiple that in my view does not make any sense. Most people know Amazon as an e-commerce and online store business, but for me the most exciting parts are the advertising business as well as the AWS cloud business, which are also the fastest growing segments at more than 30% CAGR growth over the last decade. AWS is one of the top 3 global players in the cloud computing alongside Google and Microsoft. It generates more than 100 billion in revenue and has been growing at 30% CAGR over the last decade. Then there's also the advertising business, which is now generating 61 billion in revenue and growing at over 30% CAGR as well over the last decade. Essentially what the advertising business is when you search for a product on Amazon, those first few results are usually ad placed, and that revenue goes straight into Amazon's bottom line. My humble opinion is that if you split AWS and advertising into separate companies along with Amazon's 4 other business lines, the combined value would likely be well over 2.3 trillion. Yet today, Amazon's entire valuation is just 2.3 trillion. And in my opinion, that's mispriced. The challenge for Amazon remains the free cash flow. Free cash flow has failed to expand at the same rate that net income and revenue has expanded. And I think this will be the catalyst that Amazon needs to unlock real value. Once Amazon improves margins and boosts free cash flow, that's when the stock price of this company will skyrocket. AI and robotics are already driving steady margin improvement, and I believe this will accelerate. We have seen margin improvement over the last years, as well as operating margin improvement, but I think we will see much higher margins as AI and robotics is leveraged across all parts of the business. In my base case for Amazon, I'm assuming 8% revenue growth, 16% net income growth, 45% free cash flow growth, and even then free cash flow basically only converts by 2030 into 1/3 of net income, which leaves plenty of upside, and I think it's very reasonable as well. For revenue, I have basically went in line with analyst expectations, and under those assumptions, using the DCF method, I get an intrinsic value of $64, which is much lower, and that's because free cash flow is being depressed. But with the EPS method, I get $417, which gives me a margin of safety of 47%. So even at today's price, I believe that Amazon is still undervalued. There were definitely better opportunities back 3-4 months ago, but I am buying again because I think that long-term Amazon is a no-brainer. The second stock is On Running, the fastest growing billion-dollar athletics company in the world. I have been talking about On Running since April. I was up 40% at some point this year, but since then, basically all my gains have been erased, which makes this a very interesting entry point once again. As I've said in the past, I will reveal my full portfolio at 10,000 subscribers, so if you're not subscribed, please subscribe. Revenue has grown at 57% for around the last 5 years, which is unheard of for a public athletics company. They target the premium consumer segment with strong pricing power and higher margins than competitors. On Running have basically created a new line within the athletics business. They are targeting that premium segments which wear sportswear because they're comfortable, because they want to wear them at a daily basis, and not necessarily only for sports. So On Running's competitors are not necessarily the mass market, the Nikes, the Adidas, that probably was replicated up to a certain extent by the likes of Lululemon, by Alo Yoga, but still On Running, in my opinion, has the edge. I also have 3 pairs of On shoes. I wear them daily, not just for sports, but mostly casually, and I think that is the key. They have created a lifestyle brand, and they have that brand power, which allows them to control their pricing power as well. Since 2022, they have been consistently profitable, but FX headwinds have weighted heavy on margins. If those headwinds normalize, then net margins would be much stronger than 5%. As you see, last year it was more than 10%, and due to FX headwinds, that has declined into half. And that is because On Running is a Swiss company that is listed in the US, and therefore they are prone to FX headwinds and will continue to be so in the next years, unfortunately. Free cash flow has also turned positive for the first time in 2023 when the company became solidly profitable, but there's not enough data to judge consistency and ability to turn into income into cash, but thus far it is proving quite strong. For me, the biggest opportunity, the biggest catalyst of this company is the Asia Pacific expansion, where, for example, the Tokyo flagship store is now surpassing the London Regent Street store in net sales, and the London Regent Street store is a huge store. The region is seeing triple-digit growth, and I think APAC will be a huge catalyst going forward. Margins climbed to 62%, and while profitability is still under pressure as expansions and marketing investments weigh on the bottom line, there is still a very strong 50% same-store growth, e-commerce surge, and localized athlete activations. I think the Asia Pacific region will become a catalyst for global momentum and to keep those 30+% revenue growth projections in the years coming up, which is why I believe that On can become a $10 billion revenue company by 2030. With the Asia Pacific expansion, I do not see how revenue growth will decline considerably. At a 31% revenue estimate, the company will surpass 10 billion by forward year 2030 and 1 billion in net income. And I think given the fact that it is just at 14 billion market cap today, I believe that On is mispriced, and I believe that this is an investment. This is a great company to invest in. The third stock that I wanted to talk is the most hated software as a service company in the world, and that is none other than Adobe. Adobe over the last 5 years has lost 25% in market cap, even though it has already been buying back shares aggressively and is now very close to the 2022 lows, which in my view creates a massive opportunity. There are two bear cases for Adobe, and I have gone through them in detail in my Adobe video, but the two are basically that AI will disrupt Adobe as a whole and its business model, and the second one is that Figma and Canva will lead market share of this company. But here is the thing: Figma and Canva are great for ease of use, for casual users, for younger creators and marketers that prefer these products over Adobe's complexity and expense. And while Adobe may lose ground in rapid growth segments like the web and mobile tools, it will defend its core creative. Adobe has the dominance with professional. It dominates the professional market with Photoshop, with Premiere, with After Effects. Those are industry standards, and switching costs are very high. Retraining is very expensive, and most enterprises are deeply locked into Adobe's ecosystem, especially also because Adobe owns a lot of creative assets like fonts, like stock assets, and with their vast integrated ecosystem used by organizations worldwide with more than 30 million in customers, it's very hard for those customers to switch from Adobe and go elsewhere. The moat for Adobe, in my opinion, is still legendary. To Photoshop is literally a verb, and they have very high switching costs, as I have already said. And one of the things that solidifies our hypothesis that this company is a moat is because they have failed to acquire Figma when they tried to buy it for 20 billion because of a near monopoly, and the regulator even fined Adobe with a 1 billion breakup fee. So I think Adobe generally has a very high dominance in the space, and I do suspect that they will continue to do so, and I don't see any reason why they wouldn't. For Adobe, I assume the revenue growth of 9%, EPS growth of 12%, and free cash flow growth of 12%, which I think is very conservative and is my base case. And basically under those assumptions, I'm saying that profit margin will continue to improve to roughly 33%. Revenue will continue to improve, as well as net income will double, which I think is very, very fair. And under those assumptions, in my base case, we are seeing an intrinsic value with the DCF method of $580 and with the EPS method of $513. So that gives me a solid margin of safety of 30 to 40%. So this provides an opportunity to enter this company at a very good margin of safety. And even though I usually target 50%, I think that today at this current price, Adobe is undervalued. The fourth stock that I wanted to talk about is Deckers Corporation. At 16 PE ratio, this company is growing at 15% year on year. What a steal this is. And yes, over the last 5 years, the company has performed significantly well, but over the last year, the company has lost more than 50% in market value. Over the last 20 years, the company has been growing in revenue and net income steadily, and especially over the last 5 years, even more so as trends started to see their products are as more favorable, as more trending. Currently, there is so much fear that US demand for Deckers is falling, but this is actually dead wrong. US is still growing but year on year, but hasn't been growing quarter on quarter. In the contrary, international revenue growth has been growing massively, and I think that's where the biggest catalyst of the business is, at the international growth. Deckers and Hoka is just picking up in Europe, in Asia, and I think it will continue to grow in the future. And having visited New York recently, I have been into Hoka's flagship store on Fifth Avenue, and it was packed with people in comparison with, for example, Lululemon and other brands. So I still believe there is massive growth even in the US. I think most of this is contributed because of less disposable income, but I think that Deckers will show higher growth even in the US as there's still demand for its products. So as I mentioned, Deckers owns two main brands, Hoka and UGG. UGG has been a product that has been in the market for years, for decades. And Hoka is a brand that has been growing at a much higher pace over the last few years because it has becoming more trendy. A lot more people are running, and Hoka is a leader in running technology and will continue to be one, especially at the prices that they're selling at. I myself own Hokas, and I have to say it's a great shoe. The first quarter results for 2026 outperformed what was expected. Hoka grew 20%, UGG grew 20%, and while other brands decreased 20%, this is a very small chunk of the total revenues of this company. And yes, as we said, net sales decreased 2.8%, but international sales grew 15%. And I think this is where the catalyst is. And I do still think that US will show growth in the coming years. I think this is mostly an economic problem. This is mostly a wider economic problem, not a specific Hoka problem, as other companies as well are struggling in increasing their sales in the US due to lower disposable incomes and because of the higher interest rates that is creating this notion. Also, the company has 1.7 billion in cash and has no outstanding borrowing. So overall, this is not just a company that is growing at double digits, but it's also a company that is very healthy in terms of the balance sheet. Now, for my base case, my intrinsic value for the business with the DCF model is 184, and with the EPS model is $153, which gives me roughly a margin of safety of 30 to 40%. And I have used extremely conservative assumptions. For revenue growth, I've used 8%. From net income growth, I've used 10%, and free cash flow growth 11%. Even though the company is growing at strong double-digit growth, I'm using much more conservative estimates. And even with those conservative estimates, I am seeing a company that is highly underpriced. So for me, Deckers is a buy today, and I have been buying more recently, and I think it's one of the companies that I still view as undervalued at current prices. For stock number 5, I will reveal my stock number 5 in my next video, and I will do a full investment thesis into it. I want to go deep into stock number 5 because it's a stock that I haven't spoken about yet. So if you're new here, please subscribe, and can you guess in the comments down which stock that is? Let me know in the comments below, and I'll see you guys in the next one.